All right, well, once again, good morning and good afternoon to all of you. Thank you so much for joining us today. Really excited to see such a great group of attendees here today for our webinar we're hosting at CPACE Alliance, entitled Inflation Reduction Act and CPACE, a match made in climate heaven. A little twist on the old sort of phrasing in this case. So again, once again, glad that you all could join. Just a quick introduction. My name is Nicolo. I'm Deputy Director here at CPACE Alliance. And again, I'm joined here by a great group of panelists and a great moderator today to be discussing this great intersection that we think is going to take really, I think, an important next step really in the fight against climate change here nowadays, with basically the nearly $370 billion investment that is going into the Inflation Reduction Act to help combat climate change. We know in this case that in itself is a monumental effort that has taken place in terms of trying to get climate change under control here in the United States. But then we certainly know that CPACE can really be, I think, a great way to leverage that public investment that's going to be coming from the federal government to basically continue to combat climate change and as well as adapt to it as we continue to see it as an issue moving forward. So we think that this is a really good intersection of a topic to be discussing here today, and we hope that you do get a lot of informative information out of this to be able then to help you with certainly those of you who are CPACE program administrators and then those capital providers too, who are basically helping to fund these transactions across the country. All right, so in terms of our agenda today, I'm going to give you first just a quick introduction about CPACE Alliance. Then there's a couple of housekeeping items I'd like to go over with all of you, just as a courtesy to our panelists here today. Then we'll go into talking about each of the panelists individually. And then we'll also be touching on the different topics and the information that you'll be getting in today's webinar through these presentations by our panelists. We'll go into a brief panel discussion today, just kind of touching on all the different points that we're doing in this case with respect to CPACE in this case. And I'm going to kindly ask you all to please mute yourselves at this time. And basically, then we'll go into talking about then the different sort of questions and answers that will be basically be coming in from our audience. We'll try and get to as many of those questions as we can with time that is still available to us. All right, so first and foremost, just a little bit about us as the host of today's meeting as CPACE Alliance. So we are a coalition of capital providers and transaction experts committed to achieving the public benefits of CPACE through quantity and quality of CPACE financings. Now, we do this through a number of different avenues. One is basically driving capital investment through technical assistance that we can provide to different programs. We do thought leadership in this case in terms of providing best practices and in producing white papers out into the industry. And then we also then develop and support different program administration models as well for helping to basically to do the governance of these different CPACE programs across the entire country. And of course, you see these are just some of our different members in this case who we have the pleasure of being part of our organization and furthering the efforts of CPACE in the entire industry. All right, so then a couple of housekeeping items. So I'm going to ask you to take note of your different controls right now that you are in Zoom at this point. I'm going to please ask you right now that to please keep your microphone muted during this time. So I'm going to be asking all of you, please do this right now. And also please, as a courtesy, please keep your video turned off as well during this webinar. That includes even for the panelists who are not talking at this point, because we're trying to avoid these unwarranted interruptions, and we're trying to be respectful to all the panelists during their presentations this afternoon. Questions from the audience will be taken and answered again, as I mentioned, toward the end of this webinar. And you can please place those questions in the chat area. I'll be monitoring those questions as they come in, and then we'll basically get to as many of those questions as possible before time elapses here this afternoon in terms of getting to your questions answered by our panelists. All right, so with that, let's start getting into the panelists' introductions and who's part of our presentations here today. So I'm going to first give the distinction of introducing our moderator, which is Stephanie Ma, who is a Senior Vice President of Structured Finance Research, and also is the head of U.S. Asset-backed type research, in this case for DBRS Morningstar. She has extensive experience, in this case, on dealing with structured investments, and has also been a leader in basically sounding what is basically the importance of basically ESG investments and basically of certain types of mechanisms, including PACE, to basically show to the structured finance markets, in this case, what is important in this for doing these kinds of investments and helping to fight climate change around the United States. She's been part of many different boards, and she's also at the same time authored a number of different publications and as well as articles, in which case, the very article in this case was published by her just very recently. That was the foundation for basically creating this webinar to talk on the significance between the IRA, climate investments, and CPACE. And so with that, I'm now going to turn this webinar over to Stephanie, and then she will continue the introductions of all of our panelists. Stephanie, the floor is yours.
Good afternoon, good morning, everyone, and welcome to CPACE Alliance's webinar on the Inflation Reduction Act and CPACE, a match made in climate heaven. I was telling Nicholas that I just love the title, it's so catchy. With President Biden's signing of the Inflation Reduction Act of 2022 into law this past August, CPACE may very well get an additional boost as efforts to improve affordability of clean energy and strengthening resiliency to climate change become front and center. While a total of $369 billion in federal monies is dedicated to these climate-driven initiatives through the Inflation Reduction Act, the increased focus may accelerate interest in CPACE as property owners explore other financing options to augment this aid and address these climate goals. As Nicholas mentioned, DBRS Morningstar recently published a research note on how the Inflation Reduction Act will likely spur interest in CPACE, and I'd be happy to pass it along to folks after the webinar. It's my pleasure to serve as your moderator today with this amazing group of panelists. We have David Gillespie. David is a tax partner in the New York office of Winston and Strawn. He has many years of experience representing a wide variety of clients with special emphasis on the power, infrastructure, and transport sectors. He advises investment funds, equity investors, public authorities, asset operators, lenders, borrowers, and manufacturers in the tax structuring and implementation of mergers, acquisitions, leasing, and financing transactions. David holds degrees from Wesleyan University, the University of Chicago, and Georgetown University. Welcome, David. And next we have Nicolo Pinoli. Nicolo is a partner in the Portland, Oregon office of Novogradac, where he specializes in affordable housing and community development, including the low-income housing tax credit, new markets tax credit, historic rehabilitation tax credit, and the opportunity zones incentive. Nicolo has extensive experience in a wide range of services, including financial statement audits, tax return preparation, writing applications, transaction underwriting, transaction structuring, and compliance issues. Nicolo is a frequent speaker at industry conferences and also delivers several webinars each year. In addition, Nicolo has also published many articles on various technical issues confronting the affordable housing and community development industries, and serves as a technical editor of the Low-Income Housing Community Tax Credit Handbook and Novogradac's Tax Reform Resource Guide. Nicolo received a bachelor's degree in accounting and a master's degree in professional accounting from Brigham Young University, and is a licensed CPA in California, Oregon, and Washington. Next, we have Sam Cramer. Sam is the Senior Program Director of the National Association of State Energy Officials. Sam leads NASEO's financing program and electricity planning initiatives, as well as NASEO's state energy planning assistance, and conducts research on a wide range of issues, such as energy water nexus and CPACE. Prior to NASEO, Sam worked for the National Governors Association, where he assisted governors' offices with understanding energy topics, including new utility business models, electricity market structures, shale oil and gas protective practices, and greenhouse gas emission rules. Sam received his bachelor's degree from Cornell University and his master's of public policy from American University. And last but not least, we have Peter Klein, the Vice President of Finance at the St. Paul Port Authority. Pete has issued over $1 billion in bonds to finance projects for the expansion of private businesses, non-for-profits, and public infrastructure during his time at the Port Authority. These projects have generated over 25,000 jobs, redeveloped hundreds of acres of polluted properties, and generated over $44 million a year in real estate taxes. In addition, Pete also created and administers 3 statewide energy financing programs and manages a large district energy system. As you can see, we have a great set of panelists from a diverse range of backgrounds. Before we get started, let me give you a roadmap of today's session. Each of our panelists will give a short presentation. First, David and Nicolo will discuss the notable climate provisions in the Inflation Reduction Act, going into great detail regarding various sections such as 48, 45L, and 179D. Next, Sam will talk about specific provisions and how they could help propel CPACE financing in the states. And then lastly, Peter will touch upon the creation of a revolving loan fund, otherwise known as an RLF, the provision that allows for creating RLFs in the Inflation Reduction Act, and how this can be tied to CPACE to do smaller and medium-sized projects, including solar. This will be followed by a short panel discussion, after which we'll open up the Q&A segment. You can see we have a packed afternoon awaiting for you. So David, let's start with you. Please take it away.
Or maybe I'll lead us off if that's all right. David and I are going to be tag teaming a bit, and apologies for everyone who's joining today. And maybe you weren't expecting to hear right out of bed from a couple of tax nerds, but that's the nature of the IRA a little bit. And we're not talking about the individual retirement accounts, nor for anybody from Britain are we talking about the Irish Republican Army, but certainly talking a lot about the Inflation Reduction Act. Let's go to the next slide because we've got a brief overview. Here we go. And there's a few elements we're going to touch on today. And as I mentioned, David and I will be tag teaming a bit. And we really, when it comes to the key elements that we're going to talk about, we broke them into 2 large groups. One grouping is really related to tax benefits. The other grouping relates to grants, loans, and rebates. And these are 2 of the primary ways that the government loves to subsidize activities, either through the tax code or through direct dollars that go into your pocket for specific activities. And as you note here, we're going to talk about the tax pieces first. I think in many ways, these are probably some of the most exciting elements and I think some really big changes in terms of how these operate, especially on the renewable energy tax credit side, that I know David and I are very excited about in terms of how this is going to play out and some of the really revolutionary changes that we expect to see going forward. And then next, we'll touch on, maybe not in excruciating detail, but we'll touch on some of the grants, loans, and various rebates that are out there that are going to be rolled out. I think many of these are not as imminent, whereas the tax benefits tend to be things that are being rolled out right now. A lot of the grants, loans, and rebates are likely to kick in over the next year, 2 years, 3 years or more. So a little more lead time on that side. Let's march on. And I think, David, you're going to start us off talking about the renewable energy tax credits.
Good afternoon, Nicolo. Thank you so much for your introduction. And everybody for joining us today. As a brief housekeeping matter, I just want to add an addition, since we're being recorded, that although I have retained all the global worldwide film distribution rights to this blockbuster hit, that my remarks are not intended to constitute legal advice or create an attorney-client relationship. Anyway, from the standpoint of alternative energy production, one of the most significant components of the IRA is the extension of the investment tax credit or ITC and the production tax credit or PTC. As you probably know, the ITC is a tax credit based on qualified investments in property, and the PTC is based on electricity produced by qualified facilities. So one is based on investment, the other is based on production of electricity. Anyway, the IRA extended the ITC and PTC for both wind and solar projects that start construction before 2025. After that time, wind and solar projects may be able to claim a similar technology neutral credit through at least 2032. Of course, Congress, in its infinite wisdom, did not simply extend the existing provisions. So in addition to creating the new technology neutral credit, it created a new two-tier and potentially multi-tier credit construct. So for purposes of projects to start construction 60 days or more after, this is after Treasury issues guidance regarding the new wage and apprenticeship requirements that have been added, projects will need to comply with these new requirements to get the full amount of the ITC or PTC. In addition, there are so-called bonus ITC and PTC provisions for projects that meet certain domestic content requirements or which are located in a defined energy community. So turning to the extension of the PTC and ITC, the IRA includes an extension for wind and solar projects that begin construction before January 21, 25, and that are placed in service after December 31, 2021. Now, interestingly, the extension of the PTC also extends to solar projects. So prior to the IRA, solar projects have not been eligible for PTC since 2006. Another significant component of the Act is the extension of the ITC to standalone battery and other storage. So under the IRA, a standalone storage project may qualify for the ITC if it receives, stores, and delivers energy for conversion to electricity, and then there are provisions for hydrogen and so on. Construction of an energy storage facility must begin before 2025 to qualify for the ITC, and must be placed in service after 2022, regardless of when construction begins. So following the issuance of guidance, the amount of the ITC and PTC will be based on this credit bonus system. So the base credit is equal to 20% of the full credit. So for example, with the 30% ITC, that would be 6% or 20% of 30% of the full credit, 30%. To get the full credit, projects would need to meet certain labor requirements, which include paying market wages to employees, employing a certain percentage of apprentices, and so on. These apply to projects that are larger than 1 megawatt, again, that begin construction 60 days or more after the Treasury Department issues this guidance. So the 60-day rule, above means that these wage and apprenticeship requirements wouldn't apply to existing projects that have already started construction. And of course, guidance may take some time. People are expecting it early next year, but again, with Treasury guidance, who knows? The wage and apprenticeship requirements not only apply to the construction of the facility, but also would apply to alterations and repairs, either during the 10-year PTC period, production tax credit period, or the 5-year investment credit recapture period. So looking ahead, beginning in 2025, the existing ITC and PTC will be replaced by a new technology neutral ITC PTC. The existing ITC PTC will apply to solar wind projects that begin construction before January 1, 2025. Starting in 2025, the new technology neutral credit will apply to all technologies that qualify certain minimum carbon emission standards. The credit will phase out over time, starting in, according to the current legislation, 2032. So these credits are generally equivalent to the ITC and PTC, and are also subject to these wage and apprenticeship requirements. So the IRA also adds opportunities for so-called bonus investment credit and production credit. One of the bonus provisions includes a domestic content requirement. So the ITC or PTC can be increased by 10% for projects that meet certain domestic content requirements, assuming that the wage and apprenticeship requirements are met, that we previously discussed. That is, you have to do prevailing wages and apply apprentices. The domestic content requirement generally requires that there's a certification to the government, again, in a form to be provided in guidance, which we haven't yet seen, that steel, iron, and manufactured product, which is a component of the facility, was produced in the United States. So for the current ITC, PTC, the adjusted percentage would be 40%. For the technology neutral ITC, PTC, the percentage is based on the year beginning construction, so 45% for 2025 and so on. There's a chart in the presentation which kind of goes through that. So the next slide, please. That's right. Thank you. So another opportunity for bonus is the new provision for so-called energy communities. So once again, assuming that these wage and apprenticeship requirements are met, the ITC or PTC can be increased by 10% for projects located in a so-called energy community. So as Nicolo will discuss in more detail, a project can claim an additional ITC or PTC for meeting both the domestic content requirements and being located in an energy community, which means, for example, the ITC could be 50%, or as he's going to discuss even more. So an energy community is generally defined as could be a brownfield site. It could be a community that has a certain percentage of direct employment or tax revenues related to the extraction or processing or transfer of coal, oil, or natural gas. 3 guesses where that amendment came from. An unemployment rate at or above the national average unemployment rate, or in certain cases a census tract where there's been a closed coal mine after certain dates. Again, this is all very heavily oriented towards directing investment towards places in the economy where there's been heavy reliance on carbon production. Anyway, Nicolo, let me turn it over to you.
So just to let the cat out of the bag a little bit here, we're stacking all of these exciting bonuses. If you think about in the past, 30% has been the max. And I guess if you go even further back, 10% was the ITC, which was pretty skinny. By the time we get done stacking all of these bonuses, I'm not going to switch to the next slide yet, but when we do, you're going to see the total maximum stack is 70%, which is a pretty nice subsidy if you qualify for all of these various stacks. And obviously that's an important qualifier, right? Because some of these may be difficult to do. The next 2 I'll mention when it comes to these bonuses are, it works on what we might sort of think of as smaller deals, 5 megawatts or less. Although I would guess that a lot of deals, unless you're doing utility scale solar, a lot of your deals are probably going to be 5 megawatts or less. Even pretty good sized systems, like on top of, say, a Walmart or something, that's probably going to be 5 megawatts or less. And if it's in a low income community, you get 10% bonus. Affordable housing, you get a 20% bonus. You'll notice the bonus pieces are available starting next year through 2032. So that's 10 years total. But there is a cap. You can only get 1.8 gigawatts. For those of you who are Back to the Future fans, you might be thinking 1.21 gigawatts. No, it's 1.8 gigawatts. Treasury is going to tell us how that gets allocated sometime around the 6-month mark after when the bill was enacted. One thing I want to point out, since David mentioned sort of the PTC and the ITC fund. And for those of you that have never done a renewables deal before, you might not realize the difference between the two. ITC is calculated based on the amount of money you spend on the facility, whereas the PTC, the credit, is calculated based on the amount of energy produced. ITCs are generally very syndicatable, very saleable, easy to find an investor who wants to invest in those credits. PTCs are a very different animal, since it all depends on how much does the wind blow or the sun shine in terms of how much energy your facility produces. That then dictates the number of credits. And there's also a fun interplay with the price of energy that ends up coming into play and further complicates the PTC. And so I think as a result, for a lot of you who are thinking about ITC versus PTC, for many groups, especially if you're doing smaller deals, ITC tends to be a much more attractive execution. But let's move to the next slide and let's look at how we stack up all of these bonuses. And you notice pre-IRA was at 26%. I mentioned 30, and it actually had started to already step down. There was a plan sort of stepping down over the next several years. We'd started at 30, we were stepping down to 26. Over here on the right, you see post-IRA, you've got all of these various bonuses. And if you add them all up, you can potentially get 70% if you were actually building a 4% LIHTC project and you were to add all these up. Plus, you can also qualify for that 4% LIHTC, which adds up to 110% all in, which is why I think for a lot of people who are developing affordable housing these days, considering renewable energy, the ITC, assuming you qualify for all these bonuses, which again is a big if, but assuming you do, that makes a heck of a lot of sense. The facility, the renewable energy facility, is basically free. Not only is it free, they pay you to build it. And you'll notice the one thing that's mentioned here now on the left-hand side underneath that sweet little project on the left, it says there is no longer a LIHTC basis reduction. That used to apply in the past if you were doing a LIHTC deal with renewable energy. No longer applies now, which is why you can get to that 110% mark today that you couldn't get to previously. Let's move on to the next slide. Okay, so let's talk about 45L. That was the renewable energy provisions under 48. 45L is a completely different tax credit, different flavor of credit. And this is a per unit credit. And this credit has existed for many years. But what they've done is they've sweetened it. They've made it so that the per unit credit is much higher. Obviously, if we're talking about per units and we're talking about residential rental properties, and obviously residential rental can qualify for CPACE. It just has to meet certain minimum requirements in terms of the height above grade. But when you start looking at this specific credit, which before I think was capped out at 500 or $1,000 a unit. Now, if you meet all the requirements, you can get up to $5,000 per unit. And, you know, if you're doing 100 units or 1,000 units, all of a sudden you're talking about real money. You're talking about a very significant tax credit. This tax credit, in my experience, is also very syndicatable. It's very much a situation where if you're layering this with other tax credits like renewable energy credits, low-income housing tax credits, this can generate significant additional proceeds. The one drawback that we've historically seen with this particular credit as well is that there was a LIHTC basis reduction. If you're reading the text on the lower left here, you'll see that there's now no longer a LIHTC basis reduction. So those of you that are doing low-income housing tax credit deals, looking to utilize CPACE, get the 45L credit, get the 48 credit for renewable energy facilities. This is all gravy, all additive when you update either an AC rehab deal and or a new construction deal and meet these standards. I think the next slide is for you, David. And I know this is really exciting for all of us, but especially for you, because this is a fundamental sea change in our world.
So, well, yeah, it's not as exciting as 110%. Sign me up for that, please. It is relatively exciting. So it's, I mean, interestingly, one of the most significant provisions in the IRA doesn't even create a new tax credit or extended credit, but it provides for the transferability or refundability of certain tax credits. And I just have to note that, I mean, these provisions run counter to most of the history of tax policy in this country going back to the beginning, which generally has not permitted a transfer of tax credits without a transfer of underlying property associated with the credits, and nor is it permitted tax exempt entities or state and local governments from cashing in on federal income tax benefits. So it will be interesting to see how long these provisions remain in the law and how they will be interpreted and undoubtedly limited. But in any event, the two types of provisions we're talking about here, One is known colloquially as the direct pay option. It's not actually a direct pay option, but what the direct pay, so-called direct pay option does, it allows a project owner to essentially file a tax return claiming the credit as if it were a cash payment of taxes, and then allow for a refund. So a tax exempt entity or a governmental entity that would file a tax return, show no tax due, and then claim a refund. Now of course this is not available. This direct pay is not available to wind and solar and other traditional renewable energy projects, unless the projects are owned by a municipal co-op, a state and local government, or certain other types of tax exempt owners. So it's limited in application. It does apply to certain other credits, such as, probably not relevant to folks on this call, but the 45Q carbon sequestration credit, for example, is something where ordinary people can apply for the direct pay refund. The other provision, which is going to be widely relevant, is the so-called tax credit transfer provision. Now, this would enable non-tax exempt project owners to sell their credits on the open market to an unrelated taxpayer for cash. The transfer election applies to a wide variety of credits, including the PTC and ITC in each case for years beginning after 2022. The payments are included or not included in gross income of the recipient. So if you sell the credit, you don't have to take that money in income, and the tax credit bearer can't deduct the amount it pays for the credits. So as a condition for the transfer, the government may require information or registration of the credits and the transfers necessary for purposes of preventing duplication, fraud, improper payments, and so on. So, and interestingly, if the Secretary of the Treasury determines that the amount of the credit transfer was excessive, there is a 20% penalty amount which can apply. So there'll be a little bit of danger there if you are trying to fluff up the credits too much. So in any event, these schemes could provide an alternative to traditional tax equity, and may greatly increase the ability of state and local governments to access these credits. The so-called direct pay program, and the tax credit transfer program, may provide somewhat of an alternative to traditional tax equity, but it does not allow the monetization of depreciation. To do that, you'll still have to do traditional tax equity, so-called flip partnership deals, leasing structures, and so on. But what it may do is allow monetization of credits in smaller projects that might not otherwise be of sufficient size or quality to attract tax equity investors. So it's not clear how the market will factor in the risks of the new program, including the excessive payments penalty, the delivery of information requirements, and so on, and how the market will be widened, including whether it might include individual investors. In addition, the transfers are likely to be limited to a single transfer and not include a transfer to a tax exempt entity. So, for example, a taxable person is not likely to be able to transfer its credit to a governmental entity who then applies for the direct pay refund. In any event, with that, I'll turn it back to Nicolo.
All right, we've got 1 minute to cover the rest here, and I'll just observe, David, when it's provided for in law, we don't call them schemes, we call them structures. So these sound like exciting new structures that we can hopefully use to widen the population of eligible projects. Let's speed date in the next minute the last few noteworthy provisions. 179D, this is basically an opportunity to take a big deduction. And that big deduction is up to, if you meet all the requirements, you can get up to $5 per square foot in 179 deductions. That's a pretty big deduction, especially if you're dealing with hundreds of thousands or even millions of square feet in space. There's a whole host of exciting requirements you have to meet to get this deduction. This deduction does reduce LIHTC basis if you're doing a LIHTC deal, so there's a give and take there. It does apply for years beginning after 2022, so starting next year. As I mentioned, there's a whole host of requirements, some of which you see listed here in order to qualify for that $5 per square foot deduction. But this is a potentially big deal in terms of an added tax benefit, not a credit, but certainly a deduction that's available. Let's go to the next slide where we start talking about grants. Actually, no, one last credit, which is if you're going to have an ability to charge electric vehicles, then you can get a credit for that too. Lots of details listed here. Lots of details still to come from Treasury. We'll see how it plays out. But if you're considering having an alternate fuel vehicle refueling station, including electric vehicle charging stations, you can get a credit for that. More details to come. Okay, next is the grants, I think. Yes, we've got this resiliency program, $837.5 million in direct loans and grants through HUD. You can see all the details here. The fun thing is, a lot of the details still remain to be worked out with HUD. We'll see how they come up with it. And this is going to be rolled out over the coming years, potentially through as late as 2028. So it's not like this is a today, tomorrow thing. It's coming. Next up, on the next slide, we've got the Greenhouse Gas Reduction Fund. This is coming through the EPA, $27 billion. So even bigger pool of money. And this includes grants to states, municipalities, tribal governments, nonprofits, all focused on trying to get to zero emission technologies and reduce greenhouse gas emissions. This is available through 2024, including $15 billion specifically focused on low income and disadvantaged communities. And I think next slide, we've got a quick chart that shows you over the next decade, everything that's happening, all the different programs, all the different bonuses, and when things have to happen. And it's a big runway. You've got up to 10 years for the ITC pieces specifically. So there's the ability to plan, ability to work ahead. A lot of your deals are long lead time. They take time, and you've got the ability now to work towards some of these additional benefits, additional tax benefits, and additional rebates and loans and grants in order to help subsidize your deals. So we're here to help. Both David and I would love to help as you work through the details. But I know we're ready to move on away from the tax stuff onto other provisions. So we'll wrap up for now. And I think we'll take questions later at the end of the program. And back over to you, Nicholas, or whoever's next.
I believe, Sam, you're up next.
There we go. All right. Hi, everybody. It's good to see you all here. My name is Sam Cramer. I'm a Senior Program Director at the National Association of State Energy Officials, or NASEO. Just a little bit about us. NASEO is the only national nonprofit association that supports the 56 state and territorial governor-designated energy offices. So that's 50 states, the 5 territories, and the District of Columbia. We've been around since the 1980s, and we continue to serve our members in helping them think through various energy initiatives and providing support on topics. We're basically, a key support arm for the energy offices as they help, get their states moving from point A to point B in terms of what they want the energy landscape to look like. We also do advance the interest of the state and territorial energy offices before Congress and the administration when appropriate as well. If we go to the next screen, this is really my only slide, and what I wanted to do is take a step back. And I know we're particularly focused on the Inflation Reduction Act here, but I really also wanted to mention some provisions in the Infrastructure Investment and Jobs Act, because our state energy offices are really still really highly thinking about how to leverage those funds as well. And there are opportunities for using these funds to accelerate CPACE project development. So we'll get to that in a second. So what I want to talk about first is for 4 sources here. They're not in order. of what I want to talk to them about. But the first one I want to talk about is just the U.S. State Energy Program. This is a main source of funding for our members year in and year out through congressional appropriations. It gets administered by the U.S. Department of Energy every year. And the Infrastructure Investment and Jobs Act allocated an additional $500 million to the U.S. State Energy Program, or SEP, to be distributed amongst the states via a formula allocation. There is the state energy program funding is very flexible. It can be used by the energy offices for a variety of different activities, and that includes financing programs. So if a state wanted to set up a revolving loan fund or provide interest rate buydowns or a loan loss reserve for various projects, the state energy program has the flexibility to accommodate that and enable that. The only thing is that, with this money, especially with the money with the IIJA, Davis-Bacon, Buy American, NEPA provisions, and reporting all apply to that. That can make it a challenge for folks to use it for financing, but you can certainly end up starting a successful program. We've seen successful financing programs come out of the funds for ARA, and I know Pete will be talking about an example of that in a few minutes. So I'll let him, spill the beans on that. The next one I want to talk about is the Insulate Act. This was an act that was added into the IIJA by Senator Manchin, and it is the basis of a new round of revolving loan fund programs that are going to be set up by the states. Insulate allocates $100 million for revolving loan funds to help states make improvements to residential and commercial energy programs. Residential commercial buildings, excuse me. It's Monday, and the funds are allocated to the states similarly based on the SEP formula by there. There's also an extra $150 million allocated to the 15 states with either the highest residential and commercial building consumption or highest per capita emissions. And so some of those states are going to be getting a significant amount of money to establish new revolving loan funds to focus on doing building audits and making improvements there. Up to 25% of the money in these funds can be converted to grants, and we're expecting US DOE guidance on this program to be out by mid-November. The reason why I mention this is that a lot of states recognize this isn't a ton of money, but are looking to find ways to leverage this funding in conjunction with the private sector. And one way to do that is, in my opinion, is through CPACE. There are ways you can structure these agreements to kind of leverage CPACE in addition to some of the funds that come in through Insulate and other programs. Another area that popped up that has been, I think, is important to talk about is the Energy Efficiency and Conservation Block Grants program that was established in ARA, and it's been refunded for the Infrastructure Investment and Jobs Acts. It's $150 million going to the energy offices, an additional $385 million going to local governments as well. The important thing to note with EECBG is that the financing rules have been amended so that they are now identical to the financing rules under the state energy program, which is actually a huge change and frees up a lot more money for states to leverage in financing and to establish new financing programs. And it also enables local governments to do that as well. So that's actually kind of a sea change, and we're really kind of eagerly looking through, how we can help our members think through the possibilities for establishing financing programs using EECBG funds, since the option was not available to them the last time that program was funded. Finally, I think with the Greenhouse Gas Reduction Act, I know Nicolo covered that a little bit. I just wanted to mention that EPA today announced an RFI with a number of questions on the Greenhouse Gas Reduction Fund. And that RFI comments on that are due on December 5th, 2022. I can probably put the link in the chat box here. There's also going to be 2 listening sessions around that on November 1st and November 9th from 7 to 9 p.m. Eastern time. So make sure to put those down on your calendars if you want to hear about that. There also will be establishing an advisory group to help them talk through what they want to do with the money. But again, it is a lot of money. It's coming out, and we think that there's a lot of opportunity for energy offices, for green banks, for nonprofit organizations, for other financing entities, state energy revolving loan funds, to take advantage of some of these funds, take advantage of this funding and really kind of find ways to leverage that into developing CPACE programs. We've seen in the past that, states are able to use government funds in order and can establish pretty successful CPACE programs. So I think on that note, I'd like to turn things over to my colleague, Pete Klein, who can talk to us more about how Minnesota has been really successful in this regard. Pete, are you there?
I am. Thanks, Sam.
Yep.
And I would like to focus on the creation of revolving loan funds and being able to help our smaller businesses to utilize PACE, to invest in energy efficiencies, but also to try to get PACE financing a lot more solar throughout the country. We've done quite a bit in Minnesota. Everybody should be doing a lot more, and PACE is the best way to finance these projects. Next slide. So in Minnesota, these are just general numbers. They're probably low, but by the end of the year, we'll have 400 projects at least. And we've been successful in financing smaller projects. So we've been able to fund 250 plus projects that are under 250,000. A great percentage of those are solar related. And this really started with a revolving loan fund through the ARA program. So I'm looking at the IRA coming in, supplying money to states that they can create revolving loan funds, very similar to what we did in Minnesota using the $15 million of ARA money. Next slide. One thing that, so the IRA has allocated $27 billion. It's been mentioned by the previous speakers as well, but $27 billion that is going to be eligible for the creation of these green banks or whatever each state is going to call them. The EPA is going to administer this. Sam just mentioned the information sessions that they're going to be holding. And PACE is going to be an integral part, I believe. It is already in Minnesota's program. It funds well over 90% of our revolving loan fund projects, probably 95+% of our revolving loan fund projects. PACE comes in, it makes it a lot more secure investment. So the revolving loan fund is a lot less likely to have losses. And it's a way to rapidly revolve the revolving loan fund, because once that assessment is in place, the private sector is very interested in investing in those, whether it's credit unions, community banks, or other institutional investors. They really do want to be financing these PACE-backed lending loans that were originally funded with either the ARA money in our situation or the IRA money. Next page. So in Minnesota, just for general numbers, we've got about $15 million. It's actually increased to over 17 million, but we get about 600 grand in revenue. Then we have sold either revolved funds or have externally funded national PACE lenders, and we charge a 25 basis point administration fee. So if a lender wants a 6% return on their investment, the assessment would be placed at 6.25%. At $200+ million that we have outstanding, it's probably 250 million, but at 200 million, that's $500,000. And then we also have a utility participation that supplies us with about 100 grand. That's over $1 million of revenue to the Port Authority. Every one of your agencies can be replicating that. Next slide. So this one just shows how if you had if you receive $10 million of IRA revolving loan fund money from EPA, within a year at a 5% interest rate, that's about $500,000 of interest to you. And then once you revolve that first $10 million, once you revolve that first $10 million and have a 25 basis point fee, that will just continue to
Pete, you're on mute, I think now, Pete.
sorry, I'm not sure.
Perfect, thank you.
Jump. I think everybody got muted. Okay. Anyhow, that's just an example of about $600,000. That shows you that it is an economically viable investment for every state to move forward with a revolving loan fund using PACE. Next slide. This is just an example. I think it's based on a 26% investment tax credit for a solar project. It is an immediate cash flow positive investment for the business, whether it's cash flow that they're looking for or a no-cost marketing investment. Anybody that has the tax appetite to use the investment tax credit and the depreciation, they're crazy to not be going forward with solar right now. So this one is immediate positive cash flow. What we're seeing is on a $100,000 40 kW system, the property owner is getting about $50,000 back, more than half of that investment back before they need to make their first payment. In Minnesota, the first payment's due in May 15th. So they just need to file their taxes, get the investment tax credit, depreciate the entire system, about half of the cost of the system back before they need to make their first payment through the PACE program. Next example, or slide. The next ones are just some small transactions that every state ought to be able to help. And I know the $27 billion, a significant piece of it is for lower income and disadvantaged communities. A lot of these slides are just examples of that. So this was an immigrant woman purchased this building. We helped her put HVAC units on the top so that second floor can become an event space. Next slide. YMCA. All of these slides are projects that are run by women or minority-led organizations. So this one, YWCA in St. Paul and other HVAC units. Go ahead. The Kumu funeral parlor put on solar. Absolute great investment. Next one. And this was a woman-led organization that took over an empty building and created a great employment base, a significant number of employees, and much more efficient. Next slide. This is APADANA. This is a minority-led actual solar installer, and this is the solar installation that they placed on their roof. Next slide. This is Northgate, and this is a nonprofit. It's actually training individuals in a tough part of North Minneapolis to become electricians and solar installers, and they're using the units that we help fund to help train those individuals for a career path in solar. And with PACE, we ought to be doing a lot more solar, even in Minnesota, but every state ought to be doing a lot more. Next slide. So in general, in conclusion, I guess, what we need to do is help our small businesses become more competitive, create jobs, and reduce their environmental impact. And the IRA is going to allow every state to do that with revolving loan funds. It's a great time. I'm done.
Pete. As you can see, the slide deck is packed with an enormous amount of information, providing all important accountant viewpoints in regards to the new provisions of the Inflation Reduction Act, along with how those provisions could help propel CPACE financing across the country. And then lastly, Pete just touched upon a sampling of successful case studies across St. Paul, Golden Valley, and Minneapolis. I'd like to kick open our panel discussion with our first question. What do you all view as the main obstacles to successfully implementing CPACE to help carry out the climate goals and objectives in the Inflation Reduction Act? So Nicolo, David, Sam, or Pete, either one of you can jump in, whoever wants to go first.
I'll take the easy one since nobody else is jumping in and sort of say macroeconomic conditions seem like we've got some headwinds going right now. You think about ultimately CPACE, in order to get stuff done, there've got to be builders and developers and people who are looking to make these upgrades. And if those people have expensive money and they're having high construction costs are high and they're having difficulty finding materials, all those sorts of things seem like they're exciting headwinds that may mute some of these provisions and make it more difficult to get deals done. Whereas, you know, a year, 2 years, 3 years ago, maybe we didn't have some of those headwinds.
Thanks, Nicolo. David, Sam, or Pete?
Well, again, I think the pace, the tax credits transferability and refundability is a good factor in terms of providing a component of the capital stack. I think the other issue is going to be is what, you know, how willing financial parties are going to be to enter into these, underwrite these transactions going forward, and that's I defer to the bankers in the group for that one.
I guess one other issue I'll raise, Sam, unless you wanted to jump in with something. You came off mute like you were ready to go.
No, go for it. I'll cop in after that.
I think you look at the CPACE market over time, and I'm sure many of you on the line are more expert than I am when it comes to venues and jurisdictions, but certainly one of the features, we'll call it a feature and not a bug, when it comes to CPACE is that it seems like this is a battle that we get to have with every single jurisdiction, every single state, every single city, every single county, just in terms of getting it authorized and then working through all the details around administration. And that just seems like that's, instead of just having like a nationwide law where everybody does it and it's always the same, there's sort of that added friction around, we've got to march through every city, every town, every county, every state, get it authorized, and then get it up and administered and get things going. And that, I think, just that's a headwind as well in terms of just being able to roll it out and go nuts, right? Is all the administrative fun that comes with signing up every single jurisdiction.
I would hope, Nicolo, with the advances that we're seeing in New York and bigger states like Chicago, Illinois, that those can kind of set the kind of benchmark as a standard for the smaller localities to follow and give them confidence that PACE is successful as a financing alternative.
Absolutely. And obviously the CPACE Alliance is a big part of that effort as well.
Yeah, and I think if I can hop on that, Nicolo, I agree with what you're saying there. I think, this is one of the big reasons why NASEO has been a big supporter of statewide CPACE programs as opposed to having, a locally led CPACE thing, because they add standardization and it can add kind of turnkey solutions. I think that's part of the key in terms of getting, especially some of these smaller municipalities on board that may not have the staff or the resources or the time to set up their own programs, is that if you have a standardized program that makes it extremely easy to opt in, a lot of these smaller cities and counties are going to decide to opt in because it makes it easy for them to do so. So I mean that, and that's something we're continuing to work on with our members, and is thinking through, not every state's established a CPACE program, not every state's passed authorizing legislation. And so, kind of thinking through how do we get from, the very basics of getting the legislation right all the way to, actually putting a successful statewide program in place. Unfortunately, we have good examples of that now, but that's something we're going to be focusing on with several states, coming into next year, is just kind of get those last few states on the path to getting CPACE, successfully enabled and established in their jurisdictions.
And as Nicolo mentioned, I know that the CPACE Alliance has been hard at work in standardizing kind of these templates and wordings, so that way you can use that kind of nomenclature to approach the various regional cities and localities.
I'll go ahead and throw out another one, since the rest of the group seems to be tight-lipped, but I think, and it's always been the case, right, where PACE financing often comes in, it's a little bit different. Often you have more of a senior loan, and then PACE comes in some ways, people think of it almost like a junior loan. In some ways, it's kind of a super senior loan due to its position in priority in terms of where it ends up in the capital stack. And often you end up with situations where that senior lender has to approve it, and there's various intercreditor provisions and all that fun legal stuff that goes on. Just sort of those administrative things on the financing side, as you think about, as financing gets tougher to find, as senior lenders get more picky and grouchy about stuff, as interest rates rise, to what extent does that have an impact on the CPACE world? At the same time, cutting the other way, as rates rise, CPACE becomes more attractive, right? Because it's such a low risk product for lenders that often they're willing to lend at very attractive rates compared to other sources of secondary and tertiary financing, where it can be a very attractive product. So when I talk about rising rates, it sort of cuts both ways for CPACE, both in terms of helping in some ways and in terms of making deals harder to do in other ways.
Nicolo, I think you brought up a very good point. In fact, I covered lenders' consent in that research article that Nicholas mentioned at the beginning of the webinar. Not surprisingly, as the sector has grown, new originators, including smaller shops, have entered this market. And as a result, there's been this increased focus on lenders' consent. And while the industry at large, advocates best practices, including receiving lenders' consent prior to recording a CPACE assessment, lenders' consent is not necessarily mandated across all programs. But in terms of DBRS Morningstar, we view having lenders' consent as a credit positive, because it helps imbue borrower discipline and just general good practices across the industry. So we hope to see that more. I know that the 2 or 3 major originators in this space have always received lenders' consent. We just hope that the smaller folks that are entering will do so as well. Any other comments?
I'll just chime in. Just what I've seen in the past is states have been reluctant to create these revolving loan funds that replicate what we've done in Minnesota. And there really isn't any need to be fearful that a new program is going to be a cash drain on the state. It's actually going to be a cash positive flow to the state, whatever office it is, or if they assign it to some local unit of government like Minnesota did. It is a positive cash flow investment, and you're going to be able to help the smaller businesses and nonprofits in your state. But don't be afraid of it. It is not that complicated.
As evidenced in many of the case studies that Pete illustrated. With that, I think we'll open up our Q&A. Nicholas, I'm not sure if we received any during the webinar.
Pretty sure we did. People want to talk about tax stuff from what I saw.
We certainly been getting a few different questions in here. So let me actually get kind of started with one here talking about actually carbon sequestration tax credit and direct pay. Basically saying if they had heard right, he said it was mentioned that on one of the slides that direct pay and when you presented slide 15 on tax credit, direct pay and tax credit transfer, can you give an example maybe like how that would work in this case?
Well, I think I'm not sure about an example, but it's an exception in the direct pay provision, which is largely limited to tax exempt type entities. There's an exception for the 45Q carbon sequestration credit, which would allow people that qualify for that credit to claim a direct pay benefit for that. So in other words, they could file it on they could claim a credit for it on their tax return and either get credited against tax if tax is owed, or get cash back as if it were cash payment.
I think that's the key. It's really a refundable credit in a lot of ways, where the government will write you a check after you file the tax return, claim the credit, show that you don't owe any other tax, and therefore they pay you that refund. So it's a little bit of a misnomer to call it direct pay. I do think there are questions around, well, gee, I'm a governmental agency. I never file a tax return that has credits on it, and I never get a refund, and sort of all the administrative aspects. I'm not aware of how those are being worked out yet. I think we're still waiting for some of those details in terms of how they're going to play out, unless, David, you're aware of how that's going to work.
I think you hit it just correctly, namely that we're waiting to see what comes up. But as you say, this is not this is someone is going to have to file some sort of a tax return and claim a refund. So the timing of it would be presumably similar to claiming refunds on a tax return, as opposed to, somebody mentioned in one of the chats about, is it like the 1603 grant? And again, not exactly, because that was a direct application to the Treasury for money back. This is probably going to require a longer time horizon than the 1603 grants, although some of the 1603 grants got held up too. But it's a different process.
Nicholas, I'm not sure if you see any others on my end. The chat has disappeared, so.
Oh, okay. So yes, another question I think would be interesting here, and I think this is also a bit of a reshifting, you could say, of the what we've seen as basically these projects being done with nonprofits, especially the solar projects. Can you give an example of how a nonprofit organization could utilize the direct pay provision of tax credit? Because now I think about that, because obviously now they can directly take the benefit of these ITC tax credits when they weren't always, when they were not able to do so before, and they had to rely on like a power purchase agreement or a solar lease type structure to help them with financing those particular projects. So I'm curious to hear from the panelists, maybe what your feeling, I think, on that is, and then maybe how that might actually potentially work.
I think Nicolo already described that it would, that again, it's, and I'll let him talk. You're going to have to file a tax return, even if you don't otherwise file a tax return. At least the way the law reads at the moment is that entity would file a tax return claiming the credit as if it were a cash payment of tax, and since it doesn't owe any other taxes, it would then claim a refund for that amount, and would in due course get a refund check as if it were a tax overpayment. That's the procedure. But and as Nicolo said, it's like, I mean, how exactly this is going to play out in terms of entities that don't otherwise file tax returns, I think that's we're waiting to see.
Even with nonprofits file tax returns today, but I can't think of a nonprofit. You think about Form 990. I can't think of a nonprofit that I've ever filed that has a line on there for tax credits. I don't think there's even one on the form.
Not for a 990, yeah.
Right. So I think they're going to end up having to change a lot of the forms in order to facilitate nonprofits claiming the credit and then getting the refund. I think the other alternative, of course, is the transferability feature, right? You don't necessarily have to go with the refundable credit. You could always go with the transferability, where you basically sell the credit to an investor that can take it. And that seems like another avenue if you want to avoid the quote unquote direct pay.
I think there are limitations on the transferability for the tax exempts, but they some of them may be forced into direct pay. Yes, that if it's available, that would be a way to do it.
I believe Abby had asked for Sam to put the details in, and you'll see the details. Sam included them in the chat now.
Yeah, it's regarding, I think, those listening sessions or informational sessions on the greenhouse gas reduction fund. So definitely put that on your calendars, because that they're looking for your feedback. So I think it'd be all the better. Quick question actually on then the refueling facility provision, I think as part of alternative fuel vehicle adoption. Does it include anything up in there to allow for EV charging infrastructure to be funded by that particular credits?
So I'll have to admit, when it comes to EV refueling stations, I am not the world's greatest expert. So I honestly don't know. So I think we'd have to dig into the details together and take a look. I think in general it does, and it's just a question of which pieces of your facility are going to qualify for that credit. My guess is it might end up being a little less than you would hope for in the end.
All right. This is more just like a generalized question in this case, but I think it's definitely something I think on a lot of people's minds, especially those who are maybe CPACE program administrators and certainly the policymakers who put in the IRA climate provisions. But how do you think fears or actual fears of or an actual recession will affect the willingness to invest in clean energy at this point?
Great question. I think there's no question that we're in a bit of a weird economic spot in the world right now, and certainly in this country. I think we've seen people pulling back on their investments, the bets they're placing. They're looking to de-risk and get a little more conservative. At the same time, it seems like a lot of renewables projects many of which are going ahead full steam. I do think we have a winnowing process, where some of the less economic deals are getting sidelined and shelved, and really only the strongest deals are continuing. Not that that's a bad thing. I mean, that's capitalism, right? But I think as the cost of capital rises, you're seeing that's a natural process where some deals are just not going to get done right now, whereas the stronger ones will continue to get done. And I do think a lot of these additional supports, a lot of this additional financing, tax benefits, grants, loans, all of that's going to help fill gaps on deals that absent those grants might not otherwise get done.
I think if you compare ARA to the IRA, we were in a much worse recession, and significant amount of projects went forward because of ARA. I believe a significant amount of projects are going to go forward whether we go into recession or not because of the IRA.
Yeah, I mean, I think you've got the combination of free money, plus the fact that so many people want to, for either regulatory or other reasons, want to claim that they have a green footprint and renewable footprint. I think these are both very positive. Again, obviously, a recession doesn't help, but at the same time, in a recession, if you can get free money through the credits and so on, that makes these investments perhaps more attractive in a competitive environment than some others. So I guess we'll have to wait and see.
And I think despite the possible recessionary environment that you see investors in the landscape overall, they're demanding kind of more tangible outcomes with their investments. So that's going to propel others to kind of move forward with investing in clean energy and being able to show how they're reducing greenhouse gas emissions or improving resiliency in their buildings.
All right, and then just sort of a probably simple layup question, probably for Nicolo or for David. Can nonprofits monetize the 179D energy efficiency tax credit for commercial properties?
Unless David knows otherwise, I think the answer is not directly. The only way to monetize it would be to put the property into say a partnership and then raise equity through that partnership, with some of those tax benefits being part of the sweetener for the equity raise, and using those dollars, of course, to help finance some of that property. But in terms of like the direct pay, in terms of using that deduction to offset taxes you don't owe and or generate some sort of a refund to the nonprofit, I'm not aware of any ability to go there.
Yeah, that's my understanding as well.
All right, and then one other question I have here is that with I think regards to the greenhouse gas reduction fund, in this case, that there's apparently probably going to be a lot of work and reporting requirements that would be associated with this. And they're asking, do you think that maybe it's going to look somewhere along the lines like the brownfields revolving loan fund requirements? So anybody have any insight on that? Maybe Sam, I'm going to call on you actually. Do you have maybe any insight about that?
That's a great question. I think, I've really been focusing more on the insulate funds and the revolving loan funds regarding that, which, won't be quite that similar to EPA's brownfields fund. So let me follow up on that and get better information, because, I'm still waiting to hear on some of the guidance for it to kind of get an idea as to what these are going to look like at all. So we're still in a holding pattern there. So I can get back to you with that.
Great, appreciate that, Sam. And then one other question. Let me see if I can deconstruct it here for you all to put it in simpler terms. But basically, saying, is there anything about the provisions in the IRA with regard to climate investments change anything with? I think does it change anything with regarding like the ideal project that can be funded, say by a performance contract, by CPACE, a revolving loan fund, or any kind of other grant type program? So I mean, does kind of like that ideal project that maybe could have been financed by any or funded by any of those other particular mechanisms, does that somehow get altered or changed in any way because of what IRA's provisions have in place?
I guess in some ways it has the potential to, right? When you start thinking about some of those bonuses, especially on the ITC side, you start stacking up all those bonuses. If you stack them all up, you get to 70%, big if. But a lot of those are location-based and or project-based criteria. And so in some ways you end up with, if you want to maximize the tax credits on the ITC side under the IRA, then you end up having to check a bunch of boxes and say, okay, here's where I'm going to put my project, and here are the features I'm going to have, and here are the materials I'm going to use, and here's the labor I'm going to use, all these sorts of elements in order to check all these boxes to maximize the tax credit. So from that perspective, it does seem like in some ways they're pushing you to say you've got to use these locations, these types of projects, these types of vendors, these types of materials. And that in some ways does change the projects that are likely to get done and or get the greatest amount of subsidy towards getting done.
I think another thing, the transferability and direct pay provisions will allow smaller, less desirable projects to fully access and get the benefit of the ITC and so forth, which they may not have been able to do in the past. You've got to have a pretty nice big deal to get tax equity involved in it. But so smaller projects or low credit quality projects and so on may not have had access to that, and the credit may not have been fully used or used at all. Whereas with these provisions, those projects are now going to be able to access that, quite significant credit.
All right, and I do have one final question here to saying this. So how does a municipal entity, whether it be a city or county, get the direct pay method in this case of doing their own project? And will this work like what is considered a 1603 grant, to which they'll file a return? And if so, what does then that return look like?
Maybe it'd be helpful just for those of you who aren't familiar with the 1603 program. That was going back a ways. I want to say it was part of ARA. I think somebody invoked ARA earlier. And basically the idea was, instead of generating a tax credit and then finding a tax credit equity investor who would syndicate that credit and pay you cash in equity to come into your partnership as a partner in the partnership that owned that property, instead you could take that property and apply for a grant from the federal government. There was a whole process. You had to submit a bunch of paperwork. Usually you needed an audit from a CPA, yada, yada, yada. And when you were done, you got approved and the government would cut you a check. And here's your check under the 1603 program. That's obviously very, very simplified, high level overview. This is different in terms of you don't have a separate program, separate administration. You just have a tax return that you would submit to the IRS, claiming that credit, and assuming, of course, the IRS approves, then you would in theory get a refund on that tax return. I think a lot of the mechanics around, well, gee, I'm a governmental agency that doesn't file tax returns, or if I do file tax returns, they're very different and don't have a line for tax credits and things. I think a lot of those details are yet to be decided and determined and worked out. And I think our friends at the IRS are going to have to work quickly to figure them out so that we have the administrative ability to actually claim the credit and get it refunded. But I guess part of the good news, bad news is that's kind of a 2023 problem, not a 2022 problem, because I think 2023 is the first year where you could claim the credit. And for that matter, those tax returns, if they're filed, they're not filed until January 2024 at the very earliest. So there's a little bit of a runway in terms of getting those administrative mechanics worked out. David, you came off mute. I'm sure you wanted to share a few things too.
No, well, that was a very good summary. And again, just to highlight what you said, really is that the 1603 grants under the ARRA were administered by the Treasury Department separately. It was not part of the IRS, so there was a completely separate. It was not a tax filing. It was in lieu of a tax. You weren't able to claim a tax credit if you filed the grant. So it was essentially in lieu of the ITC. It was a 30% payment directly from the Treasury in lieu of the tax credit. Whereas in this case it's obviously, if it's treated as a payment of tax, it's going to be administered by in some way, shape, or form by the IRS, not by a separate division in Treasury. I mean, it may be a special part of the IRS, but again, it will be claimed through some form of tax return reporting, and will be paid as if it is a refund of cash taxes paid. That's the way it is in the law. So it's similar to the 1603 grant in that regard, but it will be administered by the IRS, presumably, in connection with the filing of to be determined tax returns. So the short answer is we don't know how it's going to work, except that it's going to be some kind of tax filing and some kind of payback. So presumably the timing on the payment there'll be some delay on from the current incurrence of the expense to receipt of money. Is probably going to be at least 12 or more months. So you're going to presumably file a tax return and then wait for a refund payment. So this will be I'm sure our financing friends there'll be tax refund loan programs where lenders are going out, monetizing these refund payments, sort of like H&R Block.
Hopefully not those guys.
I believe we've covered all the questions posed. We have about 3 or 4 minutes left. I'd like to turn back to our panelists just for some quick closing remarks on their outlook for CPACE in the coming year. Pete, maybe we can start with you.
There we go. CPACE is going to just have a gangbuster year, and IRA is absolutely going to help it along. And all of these provisions with the HUD, $5,000 per unit, and the solar investment tax credit, all of those are just going to drive a lot more projects. And PACE is absolutely going to be the key to financing these. The lower risk and allowing it to also be flexible with these tax credits. It's absolutely going to be an explosion year for us.
Sam.
Yeah, I need to echo what Pete says. I think, CPACE is going to continue to gain ground here between the IIJA and the IRA. There are just so many opportunities to leverage, potentially leverage public funds alongside private financing for building owners to make even deeper retrofits than they normally would have. And given current interest rates and given the the potential leveraging, given how easy this money can be to access, I think this is a huge opportunity for a lot of building owners. And the fact that states are going to continue to establish CPACE programs, more local governments are going to opt into their state's existing CPACE programs. We're just going to continue to see increasing deal flow coming out of new areas. Particularly excited about Virginia coming up.
Nicolo.
Yeah, I mean, you've heard me talk repeatedly about headwinds, and that's not to suggest that those aren't real and they don't exist. But I agree with the other panelists. I think the work the industry has done over the last 3 to 5 years in terms of getting broader acceptance in the industry, finding capital sources, getting the word out about this program, getting a lot of institutional players into the market, getting things standardized, administered properly, getting uptake going, I think has really laid a lot of groundwork. So that now that there's this huge some tailwinds now in terms of all these additional subsidies, all these additional tax benefits coming into play, I think it makes it that much easier now to scale up, especially with all these jurisdictions coming online or that have come online recently, where I think there's a real opportunity for the market to move from sort of its infancy stage into juvenile stage and even into adulthood over the coming years as it really takes off.
And David.
If I can get it. Well, my crystal ball is a little foggy. That's not my strong suit to predicting the future, but I agree with the panelists. From where we sit today, it looks like we have a lot of very positive factors for a very good year.
No, I would agree. CPACE is increasingly being used to fund new construction projects across the country. I know there's some Pace Nation stats out there that say approximately 57% of CPACE financing has been earmarked towards new construction, gut rehab, and redevelopment projects so far this year. And if you compare that to last year, that was only 35%. In addition, as many of the panelists stated, we're seeing many states that have either recently enacted legislation to enable or expand its CPACE, Hawaii, Pennsylvania, Alaska, Massachusetts, while others are announcing a launch of statewide PACE programs or seeing their first CPACE transactions, Illinois, Virginia, regions of upstate New York. And I'd be remiss not to mention the largest CPACE transaction ever funded in the industry, Petros's $153 million Black Desert mixed use transaction in Utah, which closed earlier this month. DBRS Morningstar expects to see continued growth in the CPACE sector as states and localities pursue these climate goals and resiliency measures, which in many instances are mandated. And CPACE financing can be a major factor in funding these locally mandated energy efficiency and net zero carbon initiatives. In addition, as our panelists have already attested, the recent passage of the Inflation Reduction Act reinforces attention to such initiatives, whether it's extending the ITC, PTC credits, introducing neutral credits of ITC, PTC, and the stacking of such credits, which I was not aware of, increasing the 179D deduction up to $5 per square foot in deductions, the expansion of new energy home credit for multifamily building constructions, and lastly, over $837 million in grants and loans through HUD for sustainability improvements to affordable housing. But I want to give a hearty thanks to my panelists today, David Gillespie, Nicolo Pinoli, Sam Cramer, and Pete Klein, and a big thank you to Cliff and Nicholas at the CPACE Alliance for hosting this insightful webinar. And many thanks to you, the audience, for spending your afternoon with us and for being such an engaging group. It's an exciting time ahead for the CPACE sector, and I look forward to seeing how the CPACE Alliance membership cultivates its growth even further in 2023. Thank you.
Well, great. Stephanie, thank you so much for moderating. Also want to echo that and then certainly echo as well the time and the expertise that was given by our panelists today. So once again, also to Nicolo, to David, Peter, and as well as Sam, thank you again for joining us today. And I'm hopeful that basically our entire audience appreciate you all sticking around with us for this 90 minutes. We know you took in a lot of information today. This was a lot to certainly absorb, but we hope it's just going to be useful in this case as you continue to do CPACE transactions across the country and as you administer these programs for helping to get our greenhouse gas emissions down as much as possible so we can continue fighting climate change across the United States. And then just as one final note, we do have actually another webinar that will be coming up at the end of November. On Tuesday, November 29th, we're going to host a webinar on CPACE and local adoption to talk about best practices and lessons learned. So we have another great panel lined up for that particular topic area, and we're hopeful that we can get many of you to join us as well for that particular topic. And so more information will be sent out about that webinar within the coming weeks. And certainly we do hope that you attend that webinar as well. Well, with that, we're going to conclude here for today. And again, we thank you all for joining us this afternoon. And we hope to see you at our next webinar events and those in the future. Take care, everybody, and have yourself a very nice day.
Day all.